In this video, I will attempt to go over the most important formulas from the entire Level 1 curriculum. But first, I'll just make a few remarks about the types of formulas. All right, so I have categorized the formulas into 4 types. So there is type 1 where a formula exists, but what really matters is the intuition. The classic example is net present value. There is a formula for NPV, but if you are remembering NPV through the formula, then there's a problem. What I really want you to do is intuitively know what NPV is and use the calculator, but don't think in terms of that summation formula and so on. You just need to know what it is. I don't want you to be remembering that formula because it should just be a part of you. Then there is this other category where the formula exists. It's a simple formula. You know the formula. Ideally, you should also know the intuition. So wherever the intuition is straightforward, you should also know the intuition. But if you do not know the intuition, that doesn't mean that you cannot pass. I feel that if you don't have the intuition for IRR and NPV and things like that, then it's very hard to pass. But the second category, know the formula and know the intuition, but it's not something that you absolutely need to have. And then there will be some formulas where you know the formula, the intuition is too difficult, a little obtuse, so don't worry too much about the intuition, but know the formula because you will need to apply it. Now, some of you might have seen my Pareto video example where I said that in the crash course I'm covering the 20% material, so this is the entire curriculum material. I said that if you do about 20% of the entire curriculum, that covers 80% of what might be tested. Now, what I'm saying here is purely in terms of formulas. What I'm trying to do here is show you the formulas that cover approximately 90 to 95% of the formulas that can show up. This particular presentation does not include the facts. The facts that we talk about that you need to know are covered in the crash course. This only talks about formulas. And then we have a type 4. So these are difficult formulas and the probability of being tested is low. The classic example here would be the T statistic for the difference between the mean of two populations where the variance is not the same. And then there is also a formula for the degrees of freedom. So those are extremely complicated formulas. I hardly know of anyone who's actually fully learned those. So I'm not saying don't learn them. If you want to, you can. But that is very high effort and the probability of that showing up is low. And this type 4 is not included in my list of formulas. Another high-level remark I'll make before jumping into the formulas is that unlike formula sheets prepared by other prep providers where we just have 2 pages and lots of formulas are stuffed in, what I've tried to do is spread out the formulas. So I think the best use would be you print this out and make your own notes on this. So you might have some ways of remembering things that are slightly different, or if you have a comment and want to add that, you can do that. Also, this particular presentation is either being viewed off YouTube or Facebook. So I want you to place your comments. If you think something is missing or have any comments, you please put them either on Facebook or YouTube. All right, let's start with quantitative methods and time value of money. So here is a basic must-know formula. You know that when you invest and there's an interest rate, what does that rate consist of? It consists of the real risk-free rate, inflation, the default risk premium, liquidity premium, and maturity premium. You see this in Quant, and you see this also in fixed income. So it is, in a sense, a formula, but it should be totally intuitive. Something else that should be intuitive is that the future value at time n is present value into 1 plus r to the power of n. This is the future value of one particular cash flow. From this, you can also see that the present value of some particular cash flow in the future is the future value divided by 1 plus r to the power of n. So this is a must know. Next one also is extremely important. This uses continuous compounding. So if you are using a continuously compounded rate, then you use E, and you need to use the calculator for this. The effective annual return is 1 plus a periodic rate. So if your period is a quarter, then this would be your quarterly rate. M then would be 4 because you have 4 periods in a year, and then minus 1 to get a rate. If you are using continuous compounding, then the effective annual rate is e to the power of r, where r is the stated annual rate minus 1. There are formulas for annuities, but what you need to do is use the calculator. So I don't want you to memorize the complicated annuity formulas. You should simply use a calculator. What if you have a perpetuity? So you have $10 forever. What's the present value? The present value is that cash flow, the payment, divided by the discount rate. So you need to know this. Okay, discounted cash flow applications. I mentioned that there is a formula for NPV. So it's a summation of the present value of all the cash flows. But hopefully this is not something you need to memorize. This is something you just know. And on the exam, if you are calculating NPV, you do it on a calculator, plugging in the numbers. If on the exam you get a question like the following: your initial investment is 10, and then you have $3 every year forever, and the discount rate is 5%. So how would you do this? If you know the intuition, the NPV is simply minus 10 plus 3 over 0.05. So if you have that intuition, then it is easy. Now, IRR is the rate which makes NPV 0. You need to have this intuition. So if I tell you the following, if I tell you that the initial investment is 10, and then you have $3 forever, what is the IRR of this project? So then you say that minus 10 plus 3 over that discount rate is equal to 0, and then you solve for R. So again, if you know the concept, then you don't really need to memorize formulas. Okay, now these two would fall in the type 1, which you just need to know intuitively. This then is type 2, which also is a must know, the bank discount yield. It's the discount divided by the face value into 360 over T. So this is just a convention, and you have to know it because this shows up in quant, it shows up in corporate finance, fixed income, even in derivatives. So extremely important. Then holding period yield. This is a type 1 where you have to know also the intuition. So during a given holding period, what's your return? It's the change in stock price, the appreciation in stock price, and the dividend divided by your initial investment. Either you can think of this as a formula, but it's better to just know that this is how it works. Money market yield, it is the holding period yield into 360 over T. What's the difference between money market yield and bank discount yield? With money market yield, you actually look at the change divided by the investment amount, not the final face value. But anyway, this is a type 2, you have to know it. And then you have effective annual yield, which is 1 plus the holding period yield into 365 over T minus 1. So this is also extremely important. I would put it at type 2. You need to know this. Now here is something that I have seen students get confused about. Students think that effective annual yield and effective annual return are different because the formula is different. They are written differently, but they are really the same thing. If you think about it, let's say that you are taking a bond with 2 semi-annual periods, then the periodic interest rate is the interest rate for the 6-month period, which is effectively a 6-month holding period. So 1 plus the 6-month holding period, what is M? M is 2 because there are 2 periods. That is exactly what's happening here. Now here is a certain holding period, and then what is this exponent? That exponent is simply the number of periods. So if holding period yield is for a 30-day period, then 360 over 30 is approximately 12. So there are 12 periods. So these two are effectively the same thing. All right, statistics. Geometric mean, this is also a type 2. You have to know how to calculate the geometric mean. So when you are calculating the geometric mean of returns, 1 plus R. So this is for the first year, then second year. So you keep multiplying, and then 1 over n, that's the number of periods, and then minus 1. Harmonic mean I would put harmonic mean at type 3. Okay, so you should know the formula, but if you don't fully know the intuition, don't worry about it. So if you are taking the harmonic mean of 3 numbers, n is 3, and then it is divided by the sum of the reciprocals. The weighted mean, this is type 1 or type 2, so it is simply the weighted average of all the different numbers. Location of observation at yth percentile. So if you are finding something at the 75th percentile, what's the location? You arrange all the numbers in ascending order, and the location of the 75th percentile is n plus 1. What's n? The number of observations into y over 100, so that would be 75 over 100. I'm just picking 75. On the exam, you might have 25 or any other number. MAD. So this is the mean absolute deviation. This would be a type 2 or type 3. It is less popular. It's the average of the absolute value of deviations from the mean. Rather than think in terms of a formula, just think about what it means. Next, population and sample variance. I'm not even giving the formula here because I need you to understand the concept. It's a measure of dispersion from the mean. If you are given 5 numbers and you need to find the standard deviation, use the calculator. What you need to be able to figure out is, based on the question, are you calculating a population variance or a sample variance? So the calculator will give you both numbers and you figure out which one is being asked for in the question. The range is simply maximum value minus minimum value. And then Chebyshev's inequality. This is a type 3. It's just a formula that you need to learn. So 1 minus 1 over k squared for k greater than 1. Just know this. Coefficient of variation is risk per unit of return. Sharpe ratio is excess return, so portfolio return minus risk-free rate divided by the risk. And then kurtosis of a normal distribution is 3. Excess kurtosis is sample kurtosis, whatever the kurtosis is, minus 3. That's the excess over normal. 3 is normal. Okay, and then probability. When you deal with probability questions, just try to think about these formulas. So these formulas over here, at least, the multiplication rule, the addition rule, and the total probability rule, just write these down on the side the moment you see a probability question. And then you plug in based on the information and figure out which particular formula to use. So I would put these in either type 2 or type 3, but you need to know them. Then the next formula is Bayes formula. So probability of event given information into probability of event times probability of information given event divided by probability of information, the unconditional probability. Now, here again, the moment you see something that smells like Bayes, write this formula down and then try to plug in. Often, this particular unconditional probability will have to be found based on the total probability rule. But if at this stage, shortly before the exam, you haven't figured out Bayes formula, I would not encourage you to figure it out now. Your time is much better spent on practice. If this has been understood before, well and good. But not a good place to be spending your time now. This is the formula for covariance. Some people try to talk about doing this on the calculator, but I think that's too complicated. If you get a question on calculating covariance, then chances are that the numbers are simple. So in our regular lecture and in the curriculum, we have examples of calculating covariance, so make sure you do that. The correlation is simply the covariance divided by the two standard deviations. This is the expected return of a 2-asset portfolio, which is simply the weighted average of the returns. And then this is the variance of a 2-asset portfolio, which you must know. It depends on the weightages, the standard deviations, and the covariance. Later in portfolio management, we'll see a formula that takes the covariance and replaces that with correlation. All right. This is your basic counting rule, NP4. So this is the permutations formula, this is the combinations formula, and for both these I want you to use the calculator. Then we move to estimation and hypothesis testing. So binomial random variable, the probability of X successes is given by this formula, where P is the probability of success, X is the number of successes out of n terms. So make sure you know this. Expected value is n, which is the number of times you do the test, and p is the probability of success, and this is the variance. So I'd say that these are type 2 and type 3, so make sure you know them. Then normal distribution to standard normal. So if you are given a normal distribution which is not standardized and you need to change that into a standard normal where the mean is 0 and the standard deviation is 1, then you take the x value minus the mean and divide by the standard deviation. Once you do this, then you can look it up in a regular table. The safety first ratio is the expected return on portfolio minus the threshold level divided by the standard deviation. This is a lot like the Sharpe ratio. Only difference is that here you take a threshold level rather than the risk-free rate. And the higher this number, the safer the portfolio. The standard error of the sample mean. So if you are pulling out samples from a population and then you are looking at the distribution of the means, then the standard deviation of the sample means is what we call the standard error of the sample mean. That's equal to the standard deviation of the population divided by square root of the sample size. If you do not have the standard deviation of the population, then you use the standard deviation of the sample. All right, so these formulas are extremely important. I would put them as either type 2 or type 3, but type 1, 2, 3 are formulas that you must know. Confidence interval is your point estimate, x bar, that is the sample mean, plus minus this z alpha over 2 is calculated based on the significance that you want to use. So if you have confidence of 90%, you're dealing with both tails. What's alpha? Alpha is 10% or 0.1, and alpha over 2, because you are going to both tails, would be 0.05. And then the next point is the standard error of the sample mean, which is sigma over root n. If you do not have the sigma from the population, then you simply use the S from the sample, and then you would be doing the t-test if you do not know the population variance. The test statistic when you are testing for the population mean is given by this x bar, which is the population, which is the sample mean minus the hypothesized value divided by the standard error. Now this is what I've listed here. Obviously they are test stats for chi-squared test and all sorts of other tests. I would put them in category 4. If you have time, then learn them. It is the probability of those showing up in the form of tests is relatively low. So a lot depends on your degree of preparedness. So here I'm saying you must know these. The others, it's good to know. As in, it's strictly speaking part of the course. So if you are well prepared, then make sure you know those also. Okay, then we move on to economics. Obviously, you do not need to memorize the demand function because the demand function will keep varying, but you need to know the form of the demand function. The quantity demanded for a given product will generally be inversely related to the price of that product. It will generally be, for a normal good, positively related to income. And then you will have substitutes and complements. So you need to recognize what's a substitute, what's a complement. So if price of B goes up, then the quantity of A goes up, so B must be a substitute. If price of C goes up, then you have a minus sign, so C must be a complement. So know this form. When you see inverse price function, that means you express this as price of A in terms of other variables. Supply function has a similar form, but generally with supply function, the quantity supplied for a given product will have a positive relationship with price and a negative relationship with wage or some other cost. Calculating consumer surplus and producer surplus, this again needs to be something intuitive. So if you have a relationship like this where you have quantity over here, price over here, and this is your demand curve, and this is your supply curve, then what is the producer surplus. The producer surplus is the area of this triangle. I'm not giving any formula here because I expect that you know how to calculate the area of a triangle. And the producer surplus is this area. Make sure that you do questions where you can solve this. Total surplus is the sum of consumer and producer surplus. Elasticity, and remember this formula, it's the percentage change in quantity demanded divided by the percentage change in price. From an exam perspective, the way this will normally show up is the following. You will have to use this change in quantity over change in price times P over Q. The P over Q will be given. So the price will be given at a given point, the quantity will be given, and so you'll have these two. What about the change in Q over change in P? That is simply this coefficient. So the minus 0.4 is what you have over here. This is own price elasticity. What if we are talking about the elasticity of demand for a given item based on changes in price of a substitute? Then you will take this expression will simply come from here. So make sure you can do that. Another point related to elasticity, not exactly a formula, but something you need to know. Elasticity, so if you have a flatter curve, so if you have this demand curve versus this demand curve, which is more elastic? The flatter one is more elastic. So this is elasticity is higher. The other dimension is even along a given demand curve. So if you have a demand curve like this, you have price over here, quantity over here. Is the elasticity the same all across? No. The elasticity is different. So top left, this point, elasticity will be high because percentage change in quantity, where quantity is small and you increase quantities, the percentage change high? The percentage change is high, divided by price is high, top left. So percentage change in price is low. The overall fraction then is going to be high. So we'll be more elastic, top left. You need to understand this marginal rate of substitution, not exactly a formula, but if you have two products, X and Y, and you are talking about an indifference curve where you are giving up Y for X, then for you to be indifferent at a given point in time, and you are given marginal rate of substitution Yx is 4, remember that we have 1 unit of X is equivalent to 4 units of Y. So whatever is stated first is like the base currency or the base unit. So giving up 1X and receiving 4Y will keep you on the same indifference curve. Economic profit, this is equal to accounting profit minus total implicit opportunity costs. The reason is that accounting profit only takes into account explicit costs, but when you talk about economic profit, then you also want to subtract any opportunity costs that are implicit. So make sure that you know this. Another way of putting this is economic profit is total revenue minus total economic cost. Total economic cost includes both your explicit and your implicit costs. Extremely important to recognize that profit is maximized when marginal revenue is equal to marginal cost. And another way of stating this is that the marginal revenue product is equal to the price of input. If you have multiple factors, then profit is maximized when the marginal revenue product from input 1 divided by the price of input 1 is equal to marginal revenue product of 2 divided by the price of input 2. And the classic example that comes in is multiple types of labor, where you have one input is unskilled labor, another input is skilled labor. Then profit maximization happens when these ratios are equal. Okay, next, quantity, price, marginal revenue. Now these are not formulas that you need to remember, they're just for illustration. If we take a given entity where quantity and price are related like this, so this is your demand curve, then the inverse demand curve is written like this. Total revenue is simply the price times quantity, and you get something like this. The marginal revenue can be derived from the total revenue curve. Those who know calculus will recognize that we are taking the first differential to come up with marginal revenue. And why is it the first differential? Because it is the change in total revenue for change in quantity. Those who do not know calculus, just remember the following, that when you have total revenue given, to come up with marginal revenue, you simply take the coefficient of Q, and then for the Q squared, you take 2, multiply that by minus 0.5, so 2 times minus 0.5 is minus 1, and you use that. So I'm not calling this calculus because you don't know calculus, but what you have just done is your really basic differentiation. Recognize that in perfectly competitive markets, price is equal to marginal revenue is equal to the average revenue is equal to demand. Now this is between a type 3 and type 4, probability of showing up is low, but there are 1 or 2 questions in the curriculum. In monopolistic markets, it can be shown that marginal revenue is equal to price into 1 minus 1 over elasticity. The profit maximization condition is that marginal revenue equals marginal cost. This applies across all industry structures, be it perfect competition or be it oligopoly or be it monopoly. This holds true in all environments. So then we can write marginal cost is equal to this. So the profit maximization condition becomes price is equal to marginal cost over 1 minus the reciprocal of elasticity. So I do not expect you to get into the details of the intuition, and this problem might show up because I've seen it in the curriculum, and if you have time then just memorize these formulas. More economics. Aggregate expenditure of an economy, and now we move into the realm of macroeconomics. So aggregate expenditure is equal to aggregate output is equal to aggregate income. The GDP deflator, which is a measure of price levels, is equal to the nominal GDP divided by real GDP into 100. The way you can think of this is that in your base year, the nominal GDP and real GDP will be the same. So your starting point here is 100. After that, if the nominal GDP is going up faster because of increasing price levels, then that is what is creating a number that is higher than 100. All right, now these next few are type 3 or type 4, where I would encourage you to read these several times, try to memorize them, and then as you practice questions, hopefully you will be able to internalize these formulas. But you can calculate GDP based on expenditure approach. Very broadly speaking, this is consumer spending plus government spending plus business spending plus net exports. Now that is written in a somewhat complicated way over here, but the simple way of writing it is consumer spending plus investments plus government spending plus X minus M. And here sometimes we split the investments into different kinds of investments and split the government spending into different categories. And then GDP based on income approach, it's a national income, plus CAA, this is a measure of the depreciation in an economy, plus statistical discrepancy. Generally, you don't need to worry about statistical discrepancy, or it will just be given to you and you add it to your calculation. And then just try to learn these other formulas, but the best strategy, as I keep saying, is do questions and then through the questions try to remember these formulas. All right, aggregate income is equal to aggregate expenditure. This is something that holds true. And there are several formulas that come from this. Aggregate income is total consumption plus saving plus taxes. That is obviously your total aggregate income. And aggregate expenditure is what I just said. From this, you can come up with these 3 equivalent expressions. So either you can try to memorize these separately, or you can just memorize this fact and quickly derive. So now if you think about it, what this is telling you is the following. What's G minus T? This is the government fiscal deficit. It's the government spending minus taxes. That is coming from your net savings, savings minus investments, minus the X minus M. So anyway, just learn these formulas. There is a good chance that you will get a question based on these. Production function is a measure of the total output of an economy. It depends on the technology and on factors of production. Simplistically, we often take 2 factors, labor and capital, but obviously there can be many more factors. The growth in potential GDP, which is the productive capacity of an economy, depends on the growth in technology. It depends on WL times growth in labor plus WC times growth in capital. the WL and WC are relative share of labor and capital in the national income. Growth in per capita potential GDP is equal to growth in technology. So now we are talking about the productivity of a nation. So what is the growth in per capita GDP? This is actually also a measure of the wealth of a nation. So you might be getting to a higher GDP, but because purely of higher population, so everybody is still equally poor. What this tells you is whether people are getting richer, whether the income per person is going up. So that depends on the growth in technology and the growth in the capital per labor. Okay, so what is labor productivity? It's the real GDP divided by aggregate hours worked, and it can also be written like this. Potential GDP is the aggregate hours worked into labor productivity, and potential GDP growth rate simplistically depends on the long-term growth rate of the labor force and the long-term labor productivity. So ideally you want a labor force that's growing and a labor force that is also more productive. All right, this is the final economics slide. When we talk about money creation and the fractional reserve system, the money created is when you deposit. So the amount of the deposit divided by the reserve requirement. So the money multiplier is 1 over the reserve requirement. You need to know the quantity theory of money. That is M into V. V is velocity. M is the money supply. And P is the price level. And what is Y? Is the output or the income. Fisher effect is that the nominal rate is equal to the real rate plus expected inflation. This is actually an approximately equal to, and this keeps showing up. When you have an expansive fiscal policy, so lower taxes or higher spending, then that has a multiplier effect. So what is that multiplier? It is 1 over 1 minus C. C is the propensity to consume. So if that propensity to consume is more, that means that we'll have a higher multiplier. But we need to keep into account that they are taxes, so we multiply by 1 minus T. And the final reading in economics deals with currency. There are obviously lots of things to learn there, but in terms of formulas, there are two critical formulas. The real exchange rate in terms of price currency over base currency is equal to the spot exchange rate, again price currency over base currency, times the price level, which is generally the consumer price index of the base currency divided by price level in the price currency. The forward rate is equal to the spot rate into 1 plus interest in the price currency divided by 1 plus interest in the base currency. Now, if these interest rates are annualized and you are doing a forward rate for 90 days, then you will have to multiply those interest rates by 90 over 360. And finally, we have the Marshall-Lerner condition, which says that if this condition holds, where the weight of exports divided by elasticity of exports plus weight of imports into elasticity of imports minus 1, if this is greater than 0, then a currency depreciation will reduce the trade deficit. We'll now go over the formulas from FRA. Here is the most basic accounting relationship that you absolutely must know. This is a type 1. Then equity is contributed capital plus retained earnings. Your profit is equal to revenue minus expenses. Obviously you know this, but another subtle point is that you also at times need to consider comprehensive income, which is the amount by which equity is changing. That includes net income and other comprehensive income. And then other comprehensive income has its components such as unrealized gains on AFS and so on. There are a few other items that you just memorize for now and you learn them at level 3. Your assets at any given point equals liability plus contributed capital, and then beginning retained earnings plus revenue minus expenses minus dividends. Revenue recognition. So there are several ways to recognize revenue. One is the percentage of completion method. This is the most basic method for a long-term contract. Now I'm not giving a formula here because I want this to be intuitive. You just need to figure out what percentage of the formula is complete based on the information provided, and that amount can be recognized. When you sell on installments, then if you are asked to use the installment method where there is some uncertainty about collections, then the profit for a given period is equal to the cash received times expected profit as a percentage of sales. These two formulas are extremely important, basic EPS and diluted EPS. Basic EPS is from the perspective of the common shareholder. That's why we subtract the preferred dividend and then divide it by weighted average number of shares outstanding. And through practice, you need to be able to understand how to do the weighted average number of shares. Then diluted EPS, again, the formula looks complicated, but the intuition should be straightforward. If the shares were indeed diluted, so stocks or convertible bonds converted into stock, for example, or convertible preferred shares were converted into shares, then what would the EPS be? So that would be diluted EPS. And you report a diluted EPS if the diluted EPS is less than basic EPS. If it is greater than, then you just say that it's equal to basic. FRA cash flows, there is a full slide just on cash flows because this is extremely important and extremely testable. Here, I want you to use intuition when calculating the cash flow from operations. So what's that intuition? You could put formulas here, but I don't really want you to think in terms of formulas. If you are given the revenue number, so that's 100, and you are given the fact that accounts receivable went up. So accounts receivable went up from 10 to 20. So what is the cash from customers? The cash from customers is 10, and then minus the increase in assets. So let's say revenue is 100. So if revenue is 100, then the cash from customers would be 100 minus 10, which is 90. So the plus minus technique is you look at whether the item you are considering is a cash inflow or an outflow. So a revenue would be a plus, a cost of goods sold and then cash paid to suppliers would be a minus, and then any increase in an asset is a minus, and an increase in a liability is a plus. So if you use that technique, then all these questions become easy. And then I think this would be a type 3 or type 4, cash paid for new equipment, cash from sale. Learn these formulas and then apply them in some questions. Also free cash flow to firm and then free cash flow to equity. At level 1, these would be type 3 or type 4, but I would still recommend that you learn them. At level 2, then these become extremely important. FRA ratios are extremely important. I'm not listing every single ratio, but what I am doing is listing the various categories and the most popular example within each category. Then if you take activity ratios like inventory turnover, how do you come up with the ratio? The suggestion on how to do this is given. You are told inventory turnover ratio in a question. So clearly that's going to have inventory. What you do is figure out from the name that the balance sheet item is inventory. Then the balance sheet item tells you the corresponding income statement item. If it is inventory, what's the corresponding income statement item? Obviously it's cost of goods sold. Then remember that the income statement item will always be in the numerator, and in the denominator typically we'll take the average of the balance sheet item, average of beginning balance and ending balance. So based on that you can then come up with any ratio. There'll be some ratios such as net profit margin, which is simply net profit over revenue. That's purely an income statement ratio. Then there'll be purely balance sheet ratios such as the current ratio, which is current assets over current liabilities. I'm not listing all of them here. I just expect you to know them. And then when you have days of inventory on hand, this is number of days in the period divided by the inventory turnover. Cash conversion cycle formula is given right here. This also shows up in corporate finance. And the DuPont relationship, at least 2 forms are shown right here, and you need to learn this. There is also a 5 form which I have skipped. I think at least you need to know this. Obviously, if you want to be diligent, then this item can be further broken into 3 other items. FIFO and LIFO, to understand what's going on, I want you to use the 1-1-2-2 technique. So no real formulas here. So with FIFO, you assume that you buy an item worth this, then this, then this, then this. So, and with LIFO, it's last in, first out. So with FIFO, these two will be sold first, and these two will be kept in inventory. With last in, first out, you assume that you sell the two first, and then you are left with 1-1. Based on that, all the balance sheet items and ratios will make sense. Weighted average cost for a given period, you take the total cost available for sale divided by the total units available for sale. FIFO inventory is equal to LIFO inventory plus LIFO reserve. This is covered in detail at level 2, so I think probability of this showing up at level 1 is low. In fact, this is not even mentioned in the inventory reading, it's mentioned in the last reading on applications. Okay, when you talk about long-term assets, then the carrying amount is historical cost minus accumulated depreciation. This is a type 1, you just have to know this. When you do an impairment, then impairment loss is the carrying value minus the recoverable amount, and then there are some rules for coming up with the recoverable amount, which is not being discussed here. It's part of the crash course and the regular lectures. Okay, deferred tax liability. It's the carrying amount, which is a financial statement term, minus tax base, which is a tax term, into the tax rate. Income tax expense for a given period is equal to the income tax payable plus change in DTL, which is DTL at the end minus beginning, minus change in DTA. Sometimes you might simply see income tax payable plus change in net DTL, because most companies have a net DTL, so you simply look at the change in net DTL. And then on FRA, the last point is the carrying amount of a bond. I'm not showing any formula here because the carrying amount at bond issuance is simply the present value of all the payments to be made discounted at the market rate of interest when the bond was issued. And then after that we follow an amortization schedule so that the bond's carrying value works its way to par. For a premium bond, it will come down to par. For a discount bond, it will go up to par, right? Corporate finance, NPV and IRR, again, these are type 1 formulas that I just expect you to know. We've talked about them in quantitative methods. Profitability index is the present value of future cash flows over the investment amount. AAR is the average net income divided by average book value. This is probably a low priority formula. These two, NPV and IRR, are extremely important. This is the WACC formula. This is a type 1 and absolutely must be known, almost a guaranteed question. How do you come up with the YTM for cost of debt? You use IRR. The cost of preferred stock is the preferred dividend over share price. These are the various formulas for cost of equity. So this is regular CAPM. And then if you have a country risk premium, then you add that. This is the Gordon growth formula, which is a type 1 formula. You absolutely need to know this. And then from Gordon growth, you can also come up with cost of equity, which assumes that the market is efficient and the stock is fairly priced. Breakpoints. So this is where the cost of equity changes. A breakpoint is equal to the amount of capital at which the component cost of capital changes, divided by the weight of the component in the capital structure. And then this is where you are doing levering, unlevering. You want to find the beta of a project where the project is not publicly traded. So you need to know these relationships. Measures of leverage. These are fairly straightforward and you need to learn them. And then dividends and share repurchases. These are not really formulas. These are just greater than or less than relationships, which are very testable. So make sure you know these. More corporate finance. This is a major overlap with FRA. So these ratios are important. Make sure you know them. This is an overlap with Quant. So make sure you know all these yields. Operating cycle is days of inventory plus days of receivables. Cash conversion cycle is the same as net operating cycle, and we've talked about this before. This is also important. In fact, as a rule of thumb, anything that shows up at least twice automatically becomes quite important. This is the formula for cost of trade. Now, this is a formula taken straight from the curriculum. My advice is to understand the logic behind this and apply it. And then these are, I'd say, type 3 or type 4 formulas. There is an example in the curriculum and then a practice problem which talks about calculating these various costs. So learn the formulas and apply them. Just try to remember that with bankers' acceptance and commercial paper, we divide by the loan amount minus the interest. This is because the interest is paid upfront. Portfolio management. Diversification ratio is the risk of equally weighted portfolio of N securities measured as a standard deviation divided by the risk of a single security selected at random. I would put this as a type 2 or type 3, so know that. The correlation is the covariance divided by the two standard deviations, so this is very important. Now, in portfolio management, at times you might be given 3 probabilities and you might be given the value for each probability, and then you will be asked to calculate the variance or the standard deviation. So there is a formulaic way of doing it, but my preference is that you use the calculator. So that is covered in lectures. And then this formula we've seen before. We've also seen this. How do we come up with the standard deviation? Simply take the square root. All right, next, utility of an investment, that's the expected return minus half. What's A? This is the risk aversion coefficient. The more risk averse an investor, the higher the A. And then this is the variance of the investment. Notice the minus sign, so the utility is less if the risk aversion is more and the risk is more. All right, this is your market model. This is your y-axis intercept. This is CAPM type 1, absolutely must be known. This is the CAPM formula. So in the CAPM, sigma p is your x-axis, return is the y-axis, and this is your CML, capital market line. Beta is the covariance of return on I and return on market divided by the variance of the market. So know this formula. There is a symbolic way of writing it, but I prefer writing it like this because it's easier to remember. And then these are some important measures, the Sharpe ratio, Traynor, M squared, and Jensen's alpha. So I would put these as type 2. You must know them. Equity. Leverage ratio is asset over equity. So know that. The margin call price, if you buy on margin and the price starts going down, when will you get a call? It's given by this expression, where P is the initial price. And then 1 minus initial margin, that's your initial margin requirement, divided by 1 minus the maintenance margin requirement. These are numbers that you put in decimal. If you are asked to do a return calculation, it might appear complicated, but all you are doing is saying how much cash do I have at the end after paying all fees and paying off my creditor, so the firm from which I borrowed, so I pay them back, and I pay my commissions. How much money do I have at the end divided by how much money I invested. This is the money I put in minus any brokerage fee that I paid. So it's a very simple calculation once you understand what you're doing. ROE is net income over average book value. Gordon growth model that shows up here, as well as corporate finance, extremely important. So the value at time 0 is D1 divided by R minus G. And this is the formula for the perpetual growth rate. The PE ratio based on fundamentals is given right here. And this is the formula for enterprise value. So all these are extremely important. Fixed income, so pricing a bond with YTM, very straightforward. Look at all the cash flows and discount at YTM. Pricing bonds with spot rates, again, this is type 1. Look at each cash flow and discount at the appropriate spot rate. This is your full price, which is flat price plus accrued interest. And accrued interest is T over T into the payment. This is your discount basis yield. Again, this is showing up over and over. So notice here we divide by face value. This is the discount, and this is years over days. 360 is the number of days typically in a year divided by number of days. This is the add-on return, and this has also been called the money market return. So notice we divide by the initial investment. Then this is the formula for the present value of a floating rate security. And I have a separate video on this which shows that the calculation is not as complicated as this relationship seems to say. So I would not want you to memorize this formula. All I expect you to do is recognize the basic fact that you estimate the cash flows and then you discount each cash flow at the appropriate discount rate. All right. Now this is an ugly type 4 formula, the formula for Macaulay duration. You can learn it if you want, but I don't think it's necessary. What is necessary is to understand the interpretation of Macaulay duration, which is the weighted average interpretation. So make sure you know that. And then also recognize that modified duration is Macaulay duration divided by 1 plus R. And then this Macaulay duration is also sometimes written as annual Macaulay duration because we are looking in annualized terms. So the percentage change in the price, full price of a bond is given by this expression where the change in yield is in decimal. And then you have approximate Macaulay duration, which is given by this. And notice that here all in Macaulay duration and in modified and modified, approximate modified, it's the change in yield of that particular bond. When we do effective duration, then it is the same formula but change in LIBOR or change in the reference rate, which is called the curve rate. Okay, money duration is annualized modified duration into the price. So this is giving us in dollar terms the impact, and then this is the change in price is the money duration into the change in yield. This is the price value of a basis point, and then we have formulas for convexity. I think these are type 4, low probability of showing up, but if you want you can learn it. And then this formula is, I'd say, type 2 or 3, where you can estimate the change in price based on the duration impact and the convexity impact. Derivatives, not too many formulas. The forward contract payoff to long at expiration is the spot price minus forward price. So if the spot price goes up relative to the forward price, that's good for the long because this is the payoff to the long. A forward rate agreement is given by the present value, so that payoff is given by the present value of the spot rate minus forward rate into n over 360 into notional principal. So make sure you've done lots of examples. And then with T-bill futures and euro-dollar contracts, you use the IMM index, which is 100 minus the annualized rate. On a plain vanilla interest rate swap, payment to fixed rate pair on settlement dates is given by this relationship. In terms of equity swap, rather than thinking of a formula, just think of the two parties. Think of what A needs to pay B, what B needs to pay A, and then come up with the net amount. With a currency swap, again, think in terms of what each party pays, but remember with a currency swap, the amount is typically not netted. The principal or the notional principal is generally exchanged. Okay, this slide shows formulas related to options. You need to know all your payoffs. So the payoff for a long call will look like this, where this is the strike price, and then the profit diagram would look like this. So the profit diagram would be a shift down. So that would be like this, where it shifts by the amount of the call option. Now, you can learn formulas if you want, but I prefer that you think of this intuitively. So the payoff, as long as the stock price is greater than exercise price, is S minus X. The maximum profit is infinite. The break-even point is X plus C, and the maximum loss is C. Now, if you want to think of this as formulas that you need to memorize, it's up to you, but that's not what I would want you to do. I would want you to draw this picture and learn it that way. What about the short? The short would be the exact opposite. So it would be the mirror image of what we have over here. And then similarly, you can draw the payoff for the, and the profit for the put. Profit for the long will be downshift by the put amount and so on. So make sure you do these intuitively. Then with covered call and protective put, if you want to do it intuitively, you can, but I would put this as type 3, where trying to do the intuition on the exam will take too much time. So just know what they are and then learn these formulas, both covered call and protective put. Convince yourself once that they work and then learn the formulas. Also, I would say that you learn these, the minimum value, maximum value on these various European calls and European call, American call, European put, American put. So these are also quite important. And then know the put call parity formula. So these are all type 3. If you can get the intuition, well and good, but definitely know the formula. Alternative investments, There is a major segment on hedge fund fee calculations, so long examples. Now, rather than give you formulas, you will notice that in the question, they explain that, okay, you are calculating the fee based on this method. And I would strongly encourage you to do those examples, and then through those examples, just learn how to do all the calculations. Generally, the question will tell you what to do. And still, don't rely on figuring this all out on the exam. If you practice beforehand, you will be in better shape. REIT valuation, there is this term called funds from operations. So this is a type 3. Know that this is the definition of funds from operations. NAV, this is a very important concept. So NAV per share is market value of assets minus liabilities over total number of shares. So know that. This is covered in detail at level 2. So at level 1, this is type 3 or type 4. Futures price, a spot price into 1 plus R plus storage cost minus convenience yield. Just remember it. At level 1, you don't really need to go into details. And then this is the contango scenario. This is the backwardation scenario. Not a formula, but something you need to know. As always, practice a lot. And I would appreciate that on the platform where you are seeing this video, be it YouTube or be it Facebook, please post your comments and suggestions if you think something should have been in this video but not. But please put in your comments.